This is the Jane Family Institute's Social Wealth Seminar, which is an ongoing virtual semi-monthly forum exploring strategies to manage public assets and resources in service of a more just society in the United States and across the world. The Jane Family Institute is an applied research organization in the social sciences based here in New York City. And we have three main areas of focus: digital ethics, higher education finance, and guaranteed income. I am, for those who may not know me, am Paul Katz, and I'm Vice President for Special Projects at JFI, in which capacity I organize this bi-weekly seminar. Today, we are really excited to, for the first time in the history of the short history of the Social Wealth Seminar, to welcome one of JFI's own. We have Jonathan Calenzani with us, who's a fellow in JFI's Social Wealth Initiative and a senior analyst at TPICAP, who'll be presenting on bond yields in an era of slow growth. And I'll tell you more about Jonathan in just a second when I introduce him. But first, just a quick announcement, and that is that really I'm thrilled to share that we have programmed the slate for the rest of fall 2020. And we'll have 4 more sessions after this one. In 2 weeks, on Tuesday, October 27th, we'll be welcoming Asia Brown, who is the mayor of Compton, California, who'll be speaking about some very exciting initiatives underway over there. Then 2 weeks later, on Tuesday, November 10th, we'll be hearing from Steve Randy Waldman, who's the editor of Interfluidity and a very regular participant whose questions always enliven our meeting. So I'm very excited to be seeing what a whole session becomes under Steve's leadership. Then on Tuesday, November 24th, we'll be joined by Philip Rocco, who's Assistant Professor of Political Science at Marquette University. And finally, on Tuesday, December 8th, we'll be hearing from Sarah Quinn, who's an Associate Professor of Sociology at the University of Washington. So really exciting, diverse kind of group with broad-ranging interests and lots of topics that we'll be touching on in our remaining time this fall. Very excited about that. So hopefully we'll see many of you back for these meetings. I also want to mention very quickly that Jane Family Institute has 2 things that are probably of interest to many of you. We've got a web publication called Phenomenal World, and we have a weekly newsletter that is delivered on Saturday mornings. So please check them both out and subscribe if you haven't yet. So the format for today, we'll begin with our presentation from Jonathan, probably in the order of about 25-ish minutes, followed by question and discussion. And because questions and discussion are really, in many ways, the heart of this project, we'll ask if you have a substantive question that arises during the course of the presentation, please save it for the question period at the end. However, if you have kind of a clarification question, something urgent, feel free to put it in the chat, and then Jonathan can address it at his discretion. I'll also note that we are recording this session, and we'll be posting a lightly edited version to our YouTube channel for those who aren't able to make it. So if you don't want to appear, please don't have your video on. All right, so I think that's it for preliminary announcements. So now it's my pleasure to introduce Jonathan Calenzani. Jonathan is a financial services professional who currently serves as a fellow in the Social Wealth Initiative at JFI. He is a senior technical analyst at TPICAP covering foreign exchange markets and fixed income. He's previously worked at Neuberger, Berman, and Parabellum Capital. He's passionate about research in the intersections of finance, emerging markets, and social wealth. He earned a BA in economics from Reed College. Now that we've learned a little bit about who Jonathan is, let's learn much more about what Jonathan thinks. I'll pass the baton to him, and Jonathan, you can take it away.
Oh, thank you so much, Paul. And as always, like the standard disclosure, none of the views here represent the views of my employer, only my own views, and none of this should be construed as investment advice. Please do not make investment decisions from videos. So for this talk, because I've been covering fixed income for a little while now, something that has shown up a lot kind of intra-industry, and if anyone here ever watches CNBC, or really just these kind of popular business press, for now going on more than a decade, there's just kind of a steady, like there's always going to be someone every week who is, when will we get back to normal? When will the bond market return to normal? When will this era of extremely low rates come to a close? So I wanted to dig in a little bit to that. And I'm basically splitting this into, my argument will be, I think we are not in an abnormal period. I think consistent with long-term historical trends, this is a very normal time. I think we're going to continuously have low rates probably for the foreseeable future, and then think about what that means for some policy questions. So to just begin, I'm going to share a few slides. Sorry, Paul, one sec.
Oh, yeah, no problem.
Sorry, one second.
Oh, sure.
So the very first slide here is what's called the US 10-year generic rate. I started deliberately at 9/30/1981. That is when it peaked at its all-time high at 15.8. And as you can see, like, yeah, there's a lot of fluctuations, particularly in the early 80s. There's a lot of stuff happening in monetary policy. But the trend line, I think, is reasonably clear. So we're now hitting nearly like a 40-year period of a broad trend line of downward rates in the United States. And if you look abroad, this is mirrored across many, many markets. If we go to Japan, going through basically the 90s to now, you also see this kind of like broad trend line. Once again, there's the major fluxes. There are obviously still going to be market events, but the Japanese trend line has also been consistently downward sloping. We have also the British generic 10-year, also like a pretty easy fit. The Euro one. And this one I actually included because the Aussies have for a long time been, I think, one of the more interesting in terms of both interest rates and central bank policy. For the longest time, they were the wealthiest economy to avoid a recession. They've had a marked tolerance for higher inflation than many other economies. And for a long time, they were kind of considered a bit of an outlier. But even there, over really since kind of the aughts, you see still the broad general kind of global trend line in wealthy economies showing up there too. Rates are now very low, so low in fact that they have successfully issued 100-year bonds paying under 1 percentage point. And something that I think whenever you bring this up that people kind of push back on is I started at the moment where US interest rates for the 10-year hit their nominal highest peak. And you could say, well, maybe like that is true. Like we've been on this long 40-year downward slope, but that was also right at the end of a 20-year upward swing where rates went really, really high. So what are we thinking about, or how do we know that we're not just at a temporary bottom, that we're not going to see a pickup, we're not going to see this reverse itself? And I would actually argue is if you go back further in time, if you look at it through a very, very long time series, the 1970s is actually a really unusual blip. And it's not a blip that I think is suggestive of things that are terribly useful for us in thinking about our future, which goes to the paper I shared. And if you look at, this is from it, it's a great paper, I really strongly recommend it. It has, that said, it has some like side arguments I don't think are necessarily central to the paper's main takeaway in terms of engaging with questions on Piketty, on questions of returns to capital. But I think you can actually kind of segment that, and I don't think accepting the broad conclusions this necessitates believing the other arguments set forth in the paper. And his argument, which I find very compelling from the various data sources he's compiled, is that if we go back over the centuries for safe assets, which would be in today's world like the 10-year treasury bills from safe advanced economies with stable inflation and a strong history of repayment at this point, have been consistently falling kind of century in, century out, year by year. And to me, this is very, very strongly suggestive that this global trend we've seen of wealthy economies having extremely low interest rates is actually just going to continue. And you certainly see that in the market when you look at different security products that are tied to inflation expectations. Those also are very low. So even though we see many market participants voice skepticism along how long this can possibly continue, we don't really see the market in aggregate actually anticipating something different is going to happen. So I would suggest that this trend line actually will continue and probably even accelerate. Like they're something that if you look at an econ textbook in the 90s and aughts, we previously had this idea that there was this lower bound at zero, that you couldn't have bond yields below zero because investors would just, why would you do that? Why would you agree to have less money in the future than now, and why would you give that up? And we now have like cracked the zero in many places. Germany and Swiss federal debt has notably cracked this, but also German corporate debt. Siemens most notably has issued more than 2 billion euros worth of negative yielding debt. And as it turns out, which I think the Joe Weisenthal piece kind of captures really well, is there's a strong logic for this, which is the historic thinking on this was that the only reason you would be doing this basically as an investment, and as an investment, you would have to get something back in return for handing it over. But it failed to, I think, consider correctly, one of the questions is, well, why do we deposit our money in banks? And it is true, like if we, particularly if you look at like a children's book written in the 80s, kind of intro to finance, they often were like, you could open a savings account, and that would be an investment strategy. And obviously now that is not really much of a strategy. You are very, very unlikely to be able to get anything above around 0.5 percentage point. So what are the other reasons you might use a bank as an individual, or even as a corporate entity? And the answer also is it's a good way to store money. It's safe, it's secure, you can access it from many different locations, it's very convenient. And you could think that in the future, what's going to happen is we'll see more and more negative showing up in more and more places. And these type of bonds are going to transition from being an investment in the conventional sense of this is something we can invest expecting higher returns on, into an investment in the sense that this is a better choice as a way of storing money in a safe way than, say, storing it at our houses, storing it in riskier types of financial products. So I think that there isn't a clear limit to this. I think so the American US CDS markets or corporate debt market has not yet gone negative, but I do expect looking at kind of general global trends, it is going to eventually reach that point. The primary vehicle you have seen in Europe, and you're going to eventually see here, is what's called zero coupon bonds. For those who are not aware, usually when we think of bonds, we often think of them having a coupon, that is the interest payment that's paid typically twice a year. And typically that has like, a fixed percentage, like, you might get 2% paid out twice a year over the duration of the bond. Zero coupon doesn't work like that. What actually happens is, let's say you have a bond for $1,000 in 10 years, you just pay an upfront thing, you receive no coupon payments for the life of the bond, and then you receive the lump total at the end. Historically, what that has meant is there was actually a deep, deep discount because you actually were taking on more risk than you were through bonds that were also at least paying you coupons throughout the life of the bond. If there's any disruption over, say, the life cycle of the bond, you get nothing. You don't even have a tiny bit of interest to show for it. So historically, for, say, a $1,000 thing, a US corporate one might have only sold for $700, $800 per. What's now happened in places where zero has arrived is you actually are paying, say, 1,020 euros for a 1,000 euro bond 2 years into the future. And I think that is going to be the primary mechanism that this will show up in US financial markets. It also, unless we make regulatory and statutory changes, is likely the only way it can show up in US financial markets. The current bond systems are not designed to do negative interest rates. We don't have a way to take coupons from people who buy bonds. Like we genuinely just do not currently have a system by which if Ford issued a negative thing every 6 months, they could actually figure out a way to take money from you. The only way to do that basically is upfront by making you pay a higher face price. Which brought me also to this meme, which I like as a way of thinking about how Zoomers might someday think about banks. And a lot of our discourse around this is often based on this implicit idea that if we give banks money, particularly even FDIC insured money, that there's just basically a free lunch involved in it for us. And it was definitely true that there was a period where we both had high interest rates available to savers, and it was genuinely federally guaranteed. I think that's probably best seen as kind of an unusual aberration rather than something that's sustainable or something that we're at all likely to return to. So kind of sketching out now like why I think we probably are going to be in an era of low rates, I'd like to make just a few policy suggestions and then open it up to any questions or discussions other people have on this topic. And once again, if anyone would like a better explanation of different financial terms, please let me know. One thing that I think we will see a lot in an era of low interest rates is it's going to, I think, be really, really central to try and federalize as many US spending projects as possible. States operate differently than the federal government. They're not going to be able to match the federal government's both capacity, and they're also not going to get the same rate. They also are constrained in different ways that the federal government is not. 49 out of 50 states have to have balanced budgets per current laws. So they're not going to be able to run the type of deficits and do the type of, I think, financing that the federal government can do. So I think that definitely strongly encourages that if you're thinking about any type of project, putting it at the federal level, I think has to be really, really central, because a lot of the value of these really low rates and the possibilities they open up are really only going to be available to federal products or to things happening at the federal level. Beyond that, you're also going to see an increasing gap between, even as rates have fallen across a variety of products, the delta, that is the gap between what the federal government is paying and what municipalities are paying, what cities are paying, what states are paying, is actually going to grow as a percentage as we approach zero, and then will actually, depending on your calculation, become nearly infinite once negatives start arriving. This is because that a world where, you know, the federal government is, say, issuing things at 5% and the state of Illinois is issuing things at 7%, you have a 2% delta there. But as a percentage, that's actually like relatively manageable. In a world where the federal government is issuing at, say, half a percentage point, even if Illinois, which very much is not, could get down to 2.5, the percentage change there is actually just much, much larger. So again, I would just kind of reiterate, I think federalization is really, really going to be very central for almost any type of project that involves expanding the welfare state or really adding most types of state capacity. The one I'd like to jump to abroad is something that I think is also encouraging, though, is the world of low rates has spread globally. There are obviously many, many critiques of this. So certainly not, I think, a uniform like boon, but I do think it is very much the world we're in. And one where I think it has created openings is that many types of local banking infrastructures were developed and basically designed around worlds of relatively high rates. One example of this is the Selic rate, which is the Brazil interbank lending rate. If you were to go back a year ago when it hit 6.5, you would have hit the lowest it had ever been over just decades and decades and decades, and now it is down to below 2%. Something Brazil has is what's called a kit trade, which is just a way of structuring trades based on the fact that you have this like very easy, guaranteed, high-paying interbank thing available to Brazilian banks. That world no longer exists. That trade is no longer viable. And it sent a lot of Brazilian capital scrambling. And currently where that capital has gone has been hedge funds. You've seen many, many Brazilian senior bank leaders switch into alternative asset management space. It's gone into riskier equities. But having spoken to multiple LATAM traders on this, I think there's also genuinely a possibility for enterprising nonprofits to think about ways of approaching this. There is now capital that really does not have the type of safe returns it historically had, and with it has been willing to accept a higher risk tolerance. And I think that something that's kind of opens up is a real possibility for nonprofits to try and engage directly with places around the world where basically steady capital returns have been highly disruptive, and to think, can we pitch projects directly to them? Can we think about ways in which a city or a state could argue for different types of social welfare projects and offer something, you know, that like some fixed amount spread over prime in ways that just historically would not have been possible because there were these safe, guaranteed, fixed returns that banking infrastructure had evolved to deal with. So I think you're going to see globally, certainly on the bank side, there's a lot of interest in thinking about ways they can replace the returns they have lost with new investments. And I don't know, I don't think that is a space that we should agree should exclusively be left to kind of for-profit asset management. I think that is an interesting space, and certainly kind of in the vein of something like JFI, a space that I would definitely like to at least see some sort of cautious exploration of thinking, how can we, or how can various professionals try and connect capital that no longer has these kind of easy, kind of risk-free returns. So this would just be my main points, is I think we're going to expect that interest rates are going to probably stay low and possibly be continuously declining for certainly the foreseeable future. We're going to see, I think, much more pressure to federalize various programs domestically and in other advanced countries. And globally, I think we're going to see just a lot of interesting opportunities for at least thinking about, can we approach banks, can we approach private capital and think of ways to connecting that to social needs in ways that wouldn't have been feasible because their risk tolerance simply would not have allowed it even 10 years ago. But I think now, yeah, now many things are on the table because this era is going to involve like a lot of, in bank terms, you see the hunt for yield show up. You see this happening globally where desks have become much more open to various projects globally that simply would have been unthinkable even a decade ago. And I think that's a space that nonprofits should actively be considering. Is that something we can be in? Is it something we can engage with? I don't think it has to be uniformly something where I understand many people have skepticisms historically around questions of engaging with global capital, but I think this is also an opportunity. So if all that said, does anyone have any questions related to either that or just broader fixed income questions I can try and engage with?
Well, fantastic. Yeah, thank you so much, Jonathan. I think you've put several things on the table that I imagine many of us will have kind of reactions to and questions around. So just to introduce kind of this question session, I'll just ask if you have a question, please just indicate that in the chat. You could just say, I have a question, and then I'll call on you. And if you're comfortable appearing in our recording, and you can turn on your camera and your audio, and if you don't mind, introduce yourself with a quick phrase. However, if you'd prefer to ask your question anonymously, you can send it directly to me in the chat, and just let me know that you would prefer not to be identified, and I can read it anonymously for you. So those are two different ways to ask questions. So, as always, I have, both questions that I myself have prepared and also questions that I have gathered from others in advance. But also, as always, it would be great to hear, get some other people talking too. So let's just take a few seconds and see if anyone jumps in with a question. And if not, I'll start with some of those that I have amassed. All right. Well, so actually, I'd love to ask a question that we actually sort of talked a little bit about, Jonathan, previously, and that is sort of related to the implications of this low growth, low return world for subnationals in particular. You mentioned in the presentation that the kind of premium, let's say, between 7% that a city might pay and 5% that the federal government might pay is one thing, but that the gap between 0 and 2 is a completely different question. So I wonder, I mean, could you unpack that a little bit and explain,
Sure.
both what the basis for that is and what the implications are?
Yeah, absolutely. So, I mean, to clarify, absolutely, 2% is certainly better than 5. That's why you're seeing national refinancing of huge amounts of subnational debt in the United States, and globally, you're seeing this for various entities. So it's still an improvement. The difference just in terms of thinking about basically kind of the capacity question is, as we approach 0 for the federal government, a lot of stuff becomes very, very feasible in ways that was never possible. There's a whole variety of economic literature looking at this, and I'll try and link to one of those papers in the chat, where once we get into sufficiently low things, there's certain things that in terms of thinking about social returns become nearly self-financing. And that's not really possible at a state level, or that's not even possible thinking at 2%. Noah Hendron has looked at kind of tried to calculate and think about questions of what the ROI would be in this federal environment. And certainly certain things like early childhood interventions basically return nearly infinite yield. But these are things that are fundamentally only make sense financially, at least in terms of thinking about ROI, if we do it at a federal level. Now, if a state has a funding mechanism, obviously go ahead. But I think in terms of thinking about where you might want to be spending your time lobbying and where you're trying to implement these things, it really does look, at least to me, looking at these terms, that the federal level is probably the way to go.
Mm. Well, so I mean, I guess just to kind of push it a little further. I mean, what do you think that means for subnationals? What does that mean for the sort of possibilities that might open up for them? I mean, does it simply mean that we need to kind of redouble our focus on the federal government, or does it create new opportunities also at subnational levels?
I think it does strongly tilt towards the federal level. For subnationals, the one that should be considered definitely is if we can refinance, and also thinking about what the anticipated futures on those are. There's currently like a huge rush to refinance. Many municipalities are treating this as kind of a once in a lifetime scenario. So we've seen this actually kind of once in a lifetime move several times before in the last decade. So if we expect actually rates to continue going lower, the necessity of doing it at this moment might actually be somewhat lessened. And yeah, like if you can refinance on favorable terms, there will be just some capital available for new projects. So there will be some capacity there. I don't want to downplay that. But in terms of large projects, it really does seem like it's just going to tilt at a federal level. Certainly, unless you can figure out ways, which once again, there are multiple economists working on, the suggestions is unless the federal government can, and I do think there's a strong argument for, of just taking over or directly underwriting state municipal debt in ways that is just going to transfer those rates outwards. So you're either going to federalize it or you're going to try and figure out ways that various subnationals are effectively being backstopped and are just paying the federal rate. But in practice, these seem to have, I mean, these are very different political strategies, and obviously you might have more flexibility in getting the Federal Reserve to agree to this than you would in, say, having Congress agree to expand welfare programs. But in practice, these are ending up in very similar places. You're either doing it through the federal government or you're just allowing the states to basically use federal fiscal capacity.
No, thank you. Yeah, that makes sense. So I see we have a question from Steve Waldman. Steve, can I hand it over to you?
Sure, let me turn things on. Can you guys hear me?
Yes.
Yeah, hello.
Oh, okay, hello. So first, thanks for a great talk, very provocative. Imagining that trend line continuing to go without any even softer cushy bound is a little bit daunting and exciting. A few things popped out at me from the talk. One of them is implicitly the story that you're telling, I think, is very much sort of an inside-outsider story, right? So we've seen these, low-risk developed world government and even developing world government rates go down very far, very fast. And at the same time, not just in percentage terms, but in terms of absolute gaps, we've seen a lot of credits not follow. So at this moment, when interest rates are practically zero in the United States, credit card interest rates to people with, good credit scores in the United States are between 10 and 15%, which is much higher than they were, say, in 2009, when interest rates were substantially, in 2007, excuse me, when interest rates were significantly higher. And the way it's interesting the way you describe municipalities versus corporates, where in Europe, some corporates are now enjoying this sort of negative rate subsidy as though they were governments, as though they were federal governments, whereas municipalities are more like consumers. So one thing that's pretty interesting in the picture that you're painting is that it seems like the driver you described for low interest rates is basically some kinds of assets are very safe, good, convenient stores of value in this financial system that we're developing that will carry value forward over time in a way that's liquid, easy to transfer, easy to store. And some people's assets are sort of well integrated into that very sleek and oily machines, and others become credits, become risk assets, become investments. And the divide between those two things is very, very stark and not obvious, because you might think municipalities would be inside assets and corporates would be outside assets, but in the picture you paint, it's the opposite. So I guess two questions are, one, do you have a sort of theory as to what distinguishes these sort of inside versus outside assets? And two, given that it seems to be the case, the idea that there's sort of opportunities there for, say, nonprofits or people, social entrepreneurs, unfortunately, probably those things would be outside assets. And I think maybe in the answer you gave to Paul, maybe there's a hint of an answer that you have to wash them through an insider, federalize them somehow to get the opportunity that you're describing. But I'd ask you to comment on that. If you think there is an opportunity for, say, social entrepreneurs to kind of take advantage of this world in which money is effectively cheaper than free, if the asset you produce is one of these benighted convenience stores of value, how should nonprofits think about becoming an inside asset rather than an outside credit like you and me on a credit card?
Absolutely. I think those are really good questions. One that I think this shows is that there is a really, really strong safe asset premium. And a lot of times when we kind of have looked back on, we've, I think, created this kind of stylized curve that imagines there's almost like a smooth curve as you're kind of trading off between risk and safety. But the continued demand for, German bonds paying negative, Swiss bonds, actually just broadly really safe government debt at extremely low rates, suggests that for this kind of final category of like the safest asset and the safest store of value we can find, there really is a really intense premium such that the curve is not smooth. Like that there really is this kind of like disjointed curve where for everybody outside of this kind of final category of safety, like you're kind of stuck in like, the regular plain world, which can include quite disappointingly high rates. And for this kind of very narrow category of the absolute best assets, you have like this really intense premium. One thing that I think is definitely possible in driving this factor is when many people create kind of the models for this and stylize this relationship, you might have been thinking of kind of the post-war period where things like, say, German and American government debt made up a relatively large share of available assets. And as kind of global capital markets have grown, Germany, Japan, like what the bond markets seem to be signaling is they're just not issuing actually as much debt as the markets would like. So that the supply of global safe assets just is not following demand. And with that, it's going to basically be bid up, which for bonds means the yield is going to plummet. So I think that is one of the ways of thinking about like why we have like this like really, really kind of disjointed and kind of stark gap between this very small group of insiders who are doing very, very well in this new world and a lot of people kind of left out of it. In terms of thinking about how we would get more people into it, yeah, a lot of it I think, especially in terms of approaching bank capital, will probably be thinking about ways to engage with current insiders and try and think about what types of relationships you can pursue there. There is clearly like capital around the world that is now having to reconsider where it's willing to go and on what terms it's going to go because of these low yields. And basically think about ways you can directly engage that is probably the question of how you're going to translate that. And I think it is certainly going to be somewhat uphill, like it is in all cases going to be novel. But relative to, I think, that where it would have been probably, I think, for many of these things impossible, even in the aughts to even contemplate this, these new low rates, and particularly given that I'm also arguing that I think these are here to stay and quite possibly go lower. Like we've reached the zero now many, many times. It's not really clear what the true lower bound is for any of this. I think there is still potential, and I think that potential will probably accelerate over the next decade. Does that answer it, or would you?
Yeah, I mean, that's, thank you very much for a very provocative talk and an answer. And so thank you.
Yeah, definitely. And I think also something I kind of clarify that I think Steve indicated is that, well, like I work in financial services, I would certainly say in many ways it's probably a heterodox view. Even though what's interesting is if you aggregate this, the market is not suggesting this is a heterodox view. Like you're not seeing huge flights into products anticipating lots of inflation. You're not seeing lots of things suggesting that's what everyone is expecting is around the corner. In fact, the success of, for example, things like the 100-year Australian bond are all really predicated on expectations that bond prices are going to keep falling. If you had actually bought the 100-year Australian bond, which first issued at a whopping 2% interest, you now actually would be up nearly 50% in real terms as rates have plummeted. So that was actually a great trade. So, but once again, if you kind of split that and talk to individuals, you often, once again, just keep having this lingering sense that we're going to return to something we call normalcy. I just don't see it. It doesn't seem to actually be around the corner. I think we are in our normal.
Great. Well, so I think actually kind of building on this exchange, Yakov has some related questions and comments. Yakov, would you like to take it?
You know, Steve, listening to Steve's kind of question about how rates, market funding rates aren't being passed the retail fund sector, I wonder if the implication here is that the profitability of private banking is really no longer going to be there if you take this kind of long, this like, I know, this like 600 years of real rates. And if that's true, you know, what is the role of the private market in allocating capital? Can we even have a role, right? Because then, you know, you're not getting profits back. And I mean, there is evidence that the profit share is actually falling. We all talk about the labor share falling, but so has the profit share, so has the capital share, so to say, which is the return on investment. The profit share has gone up, which is the markup, right? And that kind of, yeah, like, what's the point of even trying to get market support for issuance if we can just at this point issue into thin air and directly monetize spending?
Yeah, I think like one area where I think you really are going to see that in the future is definitely with the question of consumer banking, particularly consumer banking for people who have like relatively modest savings, who do not have like major banking needs. Already a lot of consumer banking has tilted towards primarily viewing it as a way to induce you to then buy products such as like 30-year fixed, auto loans, various other financial products through the bank. And yeah, absolutely. As I think we have now entered, you already are seeing basically, we don't call it negative interest rates on personal accounts, but for example, for many kind of national US banks, if you want to open a checking account and don't have a minimum balance, there now actually is a monthly fee, which if you calculate that as a yield, you actually are just paying a negative interest rate to hold money there. So I think that is one similarly where kind of the questions around public banking become really interesting, and also possibly somewhat, at least depending on how you structure it, somewhat politically, I think there might be even more of a framework because these aren't actually promising customers. You're not stealing capital from banks and need it. In many cases, actually, because of Dodd-Frank rules, if you structured it kind of in a way that I think they would be most kind of amenable to, it would actually improve their balance sheet. And this happens primarily because Dodd-Frank, you have to have a capital ratio of 1.05. If you just take a basic, $1,000 in, particularly in like checking, and don't have an easy place to put it, that actually is driving you down, possibly past your 1.05. So these types of things are also not necessarily terribly attractive to banks. So yeah, I think this period does open up like a really interesting window where public banking might become much more urgent if a large section of people effectively are, in real terms, actually experiencing negative rates, and also just don't really make sense for both the capital requirements banks have, and also just like in terms of its investing strategy for the bank. As a more broad question, I think it is somewhat like to be somewhat cautious then on like how far we can send this. To be honest, the answer is I don't know. I think we are going to see these very low rates. It will be interesting to see like if we really did try and say like, well, do we need these firms, or could we just see how much we could issue and what the appetite is, where we would go? And the real answer, I think, is we don't know. In the past, when the initial rounds in Germany happened, they were initially considered not necessarily successful, which is to say out of the initial 2 billion euros that was to be sold at negative rates, they only sold a little under 1 billion. But the flip side of that is you're also saying they did successfully demonstrate they could, in effect, find nearly 1 billion euros worth of buyers for an auction for negative rates. So we don't really also know what the full capacity there is. But yeah, the trend line probably will keep this way, and that does, I think, put more of that on the table in terms of, are we going to leave this fully in private hands?
Well, thank you. I mean, I think this is a really interesting exchange, and definitely, yeah, sort of along the lines of Stephen and Jakob's comments. You're thinking a lot about kind of the role of public banking moving forward. I guess I'm sort of curious to ask a question, kind of zooming out a little bit, that may be beyond the bounds of this presentation. But I'm just kind of curious to hear if you have any thoughts. I mean, why are we in this world of low interest rates? Why have we reverted? Perhaps if we accept that really provocative paper you shared with us, as a reasonable measure of inflation, 700 years ago. I mean, why are we reverting to this norm?
So I've asked various economists I know, and there isn't necessarily consensus. I've heard much more consensus from people on like, yes, we're obviously in an era of very low rates, and even believing that those low rates will continue. There is a lot of divergent questions or divergent answers as to why we're here. And I think it's probably a combination of several different things. One argument which shows up in that paper, it shows up in a lot of economic history, is that actually if you look at the big periods where real interest rates have hit huge fluctuations, there's actually been war. Like the kind of core underlying thing is you've had just radical restructuring of political economies driven by wars. And as the 20th century has post-World War II, it's created kind of a new, much more stable order. The risk premium associated with kind of those type of really dramatic things has really, really shrunk. Another one that I definitely think is part of it is certainly that wealthy countries have simply not issued enough debt relative to global demand. As global market capital has increased now beyond 120 trillion, we really have not kept up with that demand at all. And in that environment, you can only press it down. And then I think the other one too is just, it appears, at least for now, total factor productivity has decreased. And with that, that has also lowered rates because there's less competition for this. One of the things you see, and you see this very much in Swiss banks, which are now explicitly charging customers negative rates at a very, very high end, typically talking over 500,000 euros, kept basically just in Swiss francs. So, someone who has enough assets that even keeping a large percentage of them in cash still makes sense. And what usually you're seeing here is that people have large stores of capital, but also don't clearly believe that there's a robust investment opportunity. So if we've entered an era of comparatively lower growth, until there's some sort of shift out of that and people are willing to hold cash, then you are going to see just very low rates. So I think it's probably a combination of all three of those factors. I don't think it's a singular story as to this one event is driving all of those.
But so, based on that explanation, I mean, would let's say that all of the kind of central bankers of the richest countries in the world are suddenly convinced that MMT is the way to go, and we see huge volumes of debt being issued. I mean, is that enough to change this broader trend? Do you think is that it?
I want to say yes. I believe that is true, but I would also kind of put the asterisk there of, am I as confident as I would have been, say, a year ago that it absolutely would be the case? No. Or the other one too is, I think much more likely is if you were to imagine the scale, and certainly I think like whatever you would imagine the conventional wisdom scale of what we would need to really move the needle has kept growing. Like where that would have been 10 years ago, you probably would have thought, if we did this if all of us kind of got together and did this at a certain amount, we would move at this much, 5 years. And now I think it would take really, really significant commitment to really try and move us out of that trend line. And even then, it would be curious to see how long we could maintain that. I mean, I absolutely believe central banks can trigger inflation if they want to. I certainly don't doubt that. But there does appear just to be larger forces that are heavily weighing down on this, which is the Bank of Japan, which I have a lot of respect for and think has done excellent work, has really kind of like struggled, I think, to hit some of the numbers they initially thought would be somewhat easier for them to hit. They've been able to engineer it, but it takes a lot.
Mm-hmm. Well, so I mean, I have many more kind of comments and questions. I just don't want to monopolize this opportunity to engage you, Jonathan. So I just want to put out again a call for questions of any sort. They could be questions or comments kind of in this kind of political economy vein that we've kind of been in, or they could be, even questions of kind of clarification or explanation. So really, any sort of question, please do share. But I guess I just now want to just kind of go off in a crazy direction. Based on that really interesting, provocative paper that you shared, that I feel like as a historian I sort of have to bristle at a little bit. And this is the kind of 700 years of
yeah, absolutely.
interest rate analysis. And I guess I was just so struck by something that I mean, if kind of the last 150 years, or rather the period that began 175 years ago and ended 25 years ago, has been an aberration, it seems like that couldn't be separated, I mean, in my mind at least, from the insane consumption of fossil fuels that have characterized that period. It seems almost precisely. I don't know. It strikes me that actually maybe this is like less a story about the financial system than it is actually about kind of the planet that we inhabit in a way. I mean, does that make any sense? Am I saying absolutely kind of crazy things now, or is that just a wild idea?
I mean, I think you're wandering into very heterodox terrain, but no, I think like there is like, certainly I'm open to that possibility. Yeah, again, I don't think I feel confident that we have like a like singular description of why this has been happening. And I actually think one of the things the paper can kind of be somewhat applauded for is committing, I think, to the outcome, but not committing to the idea that we actually have like a clear narrative to why all this is happening. Mm-hmm. And it's, in the words of the paper, appears to be super secular. Like these are just kind of trends that are continuing onwards. And again, yeah, I mean, one way that you could imagine really breaking this trend and us returning to kind of like what we might call normal or higher rates would be some sort of major shift in kind of Toller factor productivity. So if there was a new way we consumed energy, if there was something that made things a lot easier, if like one of the hot fusion projects worked out, which, obviously we're getting like very, very far afield here in terms of, I think, likely stories, but that would, I think, radically be also an event that could reconstruct all of this in a new direction. I think the upshot in terms of, I think, planning on kind of the social welfare side is, if one of your big fears is that, we're in this area of cheap money and we want to kind of plan and build things around it, if one of the big risks that would move us out is suddenly there's a lot of productivity growth and a lot of really strong, robust investments, that doesn't sound like the worst thing in the world. That sounds like actually a world that I think, an expansive social welfare state could probably easily adapt to, because you'd have a lot more opportunities. So certainly relative to, I think, the narratives that have often been pushed, which is kind of like, well, we could be, the bond market finally grow tired of us, though they always struggle, particularly for the dollar, to say where exactly they'll go. It's not really clear how you would quit the dollar. Or versions that say, well, actually, what if we just had like a bunch of inflation? The version where like, what if we had a bunch of productivity growth and there's a lot of new intriguing investments, is like, that seems like a world I would be happy with, and a world that even if we had to, in the short run, figure out new fiscal plans, still seems like a very positive world. So it does suggest that I think in terms of planning around this, that really is not a future I sadly don't think is likely, but I'm not worried if that happens.
Well, I wonder, I mean, actually, I think this points to a question that was sent to me earlier, which is actually about what the kind of, world of low returns that you're anticipating or that we're already in might mean for like the Green New Deal, or for green bonds, or any sort of investment in large scale investment in alternative energy. It sounds like actually that could also kind of have kind of like a kind of butterfly effect kind of implications as well for bond markets, perhaps.
Definitely. I mean, it suggests that there is large appetite still at very, very low rates for U.S. government debt. So things you can finance through that, yeah, there's a lot of capacity there. Yeah, the one thing like whenever you talk about green bonds or just various other things is, I think Steve's point was really well taken here, is, and once again, kind of why it's just federalization is the easiest way to do this is the products that the markets already already trust and already want. Could you do other things? Absolutely. And like, I'm all for interesting, like kind of bond market experiments. But if you wanted to raise, say, several $1 trillion, the easiest way to do it would be for the Treasury to do it through a conventional existing product that has an existing rate that's well known and considered in the safest category. Demarcating it in some way where it might be kind of fall outside that or be this other one you might end up adding a little bit of premium there, and I'm not necessarily sure what you necessarily get for that.
Hmm. Well, so I believe Steve has a follow-up. Would you like to ask it, Steve?
Sure. It's really a follow-up to your question about where this might all be coming from. I can't go back 700 years. That's too far. But one hypothesis for why we've been in such a secular decline of rates since the early 1980s is an inequality hypothesis that, fundamentally as we shift income from high marginal propensity to consume populations to low marginal propensity to consume populations, we end up with rich people with lots of money that they are interested in saving, and poorer people who might, if they were not cash constrained, create opportunities that would look like a productivity boom in your sort of better world we might get into with higher rates. But given that they are cash constrained, there's no economically visible productivity to be had by investing in satisfying needs beyond their cash constraint. So one, I'd ask whether or not you buy or don't so much buy that view, and two, if you do give it any credence at all, does it maybe sort of unfortunately threaten some of our ambitions, some of the possibilities that you're offering to us a little bit in this talk? So JFI is very into UBI stuff, and one of the things one might imagine doing in this negative interest world is basically financing UBI out of just issuing negative yielding debt in a not above zero growth economy. It just seems like a free lunch all around to everybody. But maybe it's a little bit of a mirage, because something that's that remedies inequality to a substantial degree might end up sort of killing this golden goose you've offered to us.
Yeah, so for the first point, I think it's somewhat ambiguous. I certainly think the narrative people are putting forth when they talk about inequality and low rates, it certainly sounds plausible to me. I'd feel a little bit better if we didn't see this across so many different rich economies. That is true, like even societies that have much lower kind of inequality than ours, like Japan, have seen market growth in inequality over the past. So you can reconcile that a bit, but the fact that we've seen it so thoroughly in so many places is, once again, I could imagine that it's part of the story, but I don't think it would be the only part. I would guess there's probably just many, many different factors kind of converging here. And as for kind of killing the golden goose, I don't know, like, is it possible that we could create a UBI so successful then simulates lots of investment and lots of growth, and then we don't want bonds anymore? Maybe, but in its own way, that doesn't almost feel like killing the golden goose. It just feels like you have like a really new, exciting world, similar to, I think, if kind of total factor productivity shifted because we have a really new energy thing. I mean, you'd obviously have like a temporary transition, but if you entered a world where we started having, real growth around above 4% again, if you saw real wages rising, and then we said, oh, well, now it's actually really expensive to run this program to scale it back, I don't think we would be terribly unhappy in that world. And I think policymakers would have, particularly just in a time when the economy was expanding like that, a lot of tools to try and soften the blow. So I fundamentally am just not too worried that we might accidentally stumble into a world where we engineer a future so good we have to rethink how we're currently doing bonds.
There are better things than golden geese, huh?
Yeah. Whereas, like, I think all of those are possible. I just don't think they sound like terribly difficult worlds to navigate through policy-wise, particularly given where we are now. Like, I would love to exist in a world where, in fact, there was not endless appetite for near negative paying things because there were so many attractive things happening in the world.
I agree.
Can I follow up on that a bit?
Yeah, go for it.
I'm also very skeptical, like, of taking 700 years and doing a moving average on it, right? Because I'm just eyeballing the series right now, and I think you're getting much more variance as you get the expansion of like credit markets that have more agents in them, right? And I think that's actually really interesting, because that says that there might be some kind of real economy feedback mechanisms we can to raise yields by getting more productivity, right? We might be underinvesting, for example, or the demand side might be misdistributed. And I think that might be, they're qualitatively different than the 13th century because we just have more participants in markets, right? Like we have fully marketized societies with like a reference rate that's very real, where you don't really have a reference rate in the 13th century, right? Like it's a very localized set of reference rates. And I'm not sure, and that will obviously increase information, costs, and that'll obviously increase your interest rate if you're trying to compose it via one or two reference rates. But so I think like we really need to think about, like, as I'm looking at that series, the variance is very, very strange on the time series.
Oh, absolutely. And he goes into some of that. One of the things that happens at multiple points kind of in that history series, though once again, I think it reinforces kind of the question of, have we entered, at least relative to other periods, a time of either comparative stability or at least perceived stability by markets, is he mentions like there's many areas of Europe where prosperous merchants are just not able to secure credit at all because they're perceived as being in areas that are highly at risk for war. So like there's very narrow geographic areas, particularly at the beginning, where you're seeing most of that activity. And once you leave that area, there just isn't really much evidence that people are even willing to kind of extend you into markets in any form, even if you had what would conventionally at the time have been thought of as being like a comparatively on a personal level good credit risk. And yeah, no, I mean, I like that paper more, I think, as both a kind of provocative paper that opens up a lot of doors, as a way of, I think, trying to shift away from, at least kind of in my kind of sector of the world, where you see so much of this idea that we're going to return to some sort of kind of post-war normal where rates are definitely going to rebound. But I definitely wouldn't like hold this paper up as like a pure gospel that like, 3/4 of a basis point every year is guaranteed to decline indefinitely.
Yeah, it's a very, very time series. And actually, when 7-year average for a social program is deadly, right? Like 7 years is a long time when you're trying to implement policy, and it can really hurt you. So like you're gonna get caught in what the moving average hides much more as an applied person than looking at 700 years.
Yeah, absolutely. I think the bigger one is both thinking of that and also just kind of general global trends in the bond market is you're not seeing a lot of signals currently from the market to expect that our current era is going to end anytime soon. Okay. And if anything, we've repeatedly hit these kind of periods where different firms have tried to imagine that somehow maybe it's central banks somehow kind of misapplying things, maybe it's some kind of period of like a bond bubble, but none of that has really come to pass. So to me, all this suggests is I do think where we're at is at very least our normal and might well kind of accelerate.
Well, thank you, Jonathan. I want to put out a last call for questions. So if anyone has a question and has not yet shared it, now is the time to jump in. And if not, by the time I finish the sentence, I will share a question that has come from Okay, I'm just going to go for it. I'll share a question that has come from our Director of Operations, Alex Jacobs, who had to drop off a couple minutes ago, but passed it along. And it's kind of about sort of the political power of bond markets. And I think it's a kind of clever way of asking, will bond market, what does this mean for the power of bond markets relative to the past? And specifically, he cited James Carville's famous statement that if he were to be reincarnated, he'd want to come back as the bond market. And I wonder, do you think would he still say that today, or is this kind of fundamentally a challenge to the power of bond markets, or even likely to reinforce that power?
I think it depends how you take that, because I can see that going in both directions. On one hand, what has really not come to happen, and kind of people at different ways kind of in both sides of the spectrum have at different times, I think, wanted and kind of wish they could will into being a world where the bond market would kind of nudge us in whatever political direction they wanted. And particularly, like certainly thinking back in the past decade, many people have made kind of predictions that the bond market was going to be upset at like stimulus spending or various, as our GDP has moved past 100, or when we had a new national ratings downgrade. And now that really came to pass. Like the bond market, in that sense, seems to be like relatively politically indifferent. I don't think that means it's like somehow politically indifferent to questions of how capital is distributed, to questions of how things are allocated. And certainly, I think there's more ability for them to move money out of emerging markets. But at least for US dollar debt, we haven't seen that to much of an extent. So yeah, I'm not necessarily convinced it's there. The flip side, though, is in this era of very, very low rates, you once again, though, can see, and you can kind of stylize this, is that if there was a world where, say, Germany for a long time is hovering just ever so slightly negative, and there was a period where the entire curve out through 30 years went negative, and then there's a period where, say, the United States is hovering ever so lightly positive, that actually is a really, really large gap in ways that, like, the type of gaps that you would be thinking about in real terms actually would have been smaller at periods where they were both positive. So I think you can see this evolving in both directions.
Yeah, well, it's very interesting. I mean, it certainly, I mean, what has at least come across to me from your presentation, Jonathan, is that we are in a moment of possibility as much as sort of one of challenge. So I guess that's a kind of an exciting and optimistic spin on what has been, I think, a really fascinating and provocative presentation. So we're a couple minutes past our closing time, so I think it's a good time to wind down. I just want to remind everyone that in 2 weeks, on Tuesday, October 27th, at the same time, 6 p.m. Eastern, we will be back to hear from Asia Brown, Mayor of Compton, California. So please join us again in 2 weeks. Invite your friends, and join me in once again thanking Jonathan for a really fantastic presentation. Thank you so much.
Thank you.